Hello everyone, welcome to the latest episode of Market Bites. I hope everyone is doing well. We were free until about an hour ago. Unfortunately, Nezha is feeling a little bit under the weather, so Bret and I will take you through this episode. Bret, how you doing, mate?
Doing good, doing good. I'm in New York this week. Tomorrow is 70 degrees. As you know, I can't convert from, our unit to metric or any other time apparently. So I don't know what that is in Celsius, but tomorrow will be 70 degrees here. I'm very excited.
So that, I mean, I'm also struggling to guess what that is, but I'm just gonna guess by the excitement in your voice that that's not too bad. It's pretty sunny.
Yeah, that's comfortably warm.
Yeah, nice.
Not sweating, but just comfortably warm.
We had a phenomenal last Wednesday. The weather was lovely. It was t-shirt weather, shorts weather if you wanted. And then today, 7 days later, I looked out my window about hour and a half ago, and it was hailing. And I just thought that is classic British weather. And I look now, honestly, at the right, and it's blue skies. So we've had every possible bit of weather you can imagine today, which is kind of like the markets at the moment, all over the place.
Truly.
It's been a phenomenally busy first quarter. The title of the podcast, for everyone that's already seen it, will give it away in terms of what we're talking about. We're going to discuss the latest retail investor beat. We do this every 3 months, which is always something I look forward to, just to get an idea what retail investors are thinking. And for those that haven't joined one of these before, survey 11,000 retail investors across 13 different countries, and they don't have to be an eToro user, so it's a pretty broad spectrum, and we ask them a number of different questions. Some will be the same questions asked the quarter before, a year before. Some will be completely new, so we get a really big range of answers and topics discussed. So I think it's a pretty important thing, and Bret, every time we do this, we talk about the importance of the retail investor. And I mean, I will go through the findings very shortly, but I always find it very interesting to see, and I know you agree with that.
Yeah, absolutely. I mean, I think, even looking back over 2025 to see retail outperform institutions, to see them really step into that, the dip we had, really 1 year ago, late March, early April, and then set themselves up for a strong year of outperformance. I mean, I think, they continually shake that sort of like dumb money label that they were given. However, I don't know when if that was 5 years ago or 20 years ago, maybe, but I think they keep working on shaking it off. So I think seeing what they're doing every quarter is good work.
Yeah, absolutely. And you're right. It was pretty much a year ago, wasn't it, that the markets looked to have found a bottom. I can't remember the exact day that it was, but we rallied for, considerable amount for those people that timed the dip well. And obviously that's tough. Of course it is. But would have been looking at a very good year last year. It is worth noting that the survey was conducted before the geopolitical tensions got a little bit worse. So bear that in mind. But it's quite interesting, actually, a lot of the results, not that they say they saw things coming, but a lot of people were wary of sort of tensions going into the beginning of the year and now quarter two as well. So we'll discuss all of that shortly. The first point, we've got four that we're going to go through. And the first is that retail investors recalibrate expectations for AI stocks and the Magnificent Seven. So the survey that we just talked about, those 11,000 retail investors, found that 43% expect AI-related stock prices to increase this year, which is down from 52% in the previous quarter. So from 52 to 43. And just a quick stat, that is the lowest reading since the question was first asked in quarter four, 2024. And then also 40% believe the Mag 7 will outperform the broader market in 2026. That was 47% last quarter. On one hand, I guess, for a lot of retail investors, if we asked 100 people to name, 10 stocks, the Mag 7 are probably going to be the ones that everyone would know. So they're the most popular on that front. So to see those numbers come down might be a little bit of a shock. Bret, I've got the year to date performance of the Mag 7. And I'm just going to run through them very quickly. It is 4.24 in the UK on the 25th of March. You never know what's around the corner. But Nvidia down 5%, Apple down 6, Amazon down 6, Meta down, let's call it 8, Google 8, Tesla down 11, Microsoft down 21%. People have been unwinding on tech and Mag 7 for a while, so fair play to retail investors for, feeling like that they agree with that view of what the market's been doing.
Yeah, I think too, if you look at, let's say 2025 again, I think, correct me if I'm wrong, but I believe only two of the Mag 7 names outperformed the S&P last year. So, and when we look back over the data, basically look at this quarterly now, we see that trend. The question being, do you expect Mag 7 to outperform? We've seen the number of respondents that say yes to continue to go down. It's not just like, oh, they just changed their mind in February. It's like we've seen this sort of steady decline in both of these groups, AI and Mag 7, and we've sort of seen that rotation into be something like gold or even commodities in general, like oil. And I know we'll touch on sort of oil allocation in a little bit, but I think it's also worth just sort of pointing out when we go back to 2023. I remember having some of those analyst meetings, and we kept calling it, this is such a weird bull market, because it was like the Mag 7, Eli Lilly, Berkshire, and that was basically it. Like, dude, counted for like all of the gains in the S&P 500. Every other sector was like lagging. It was just mega cap tech. And then 2024 came along, and it was AI. It was the NVIDIAs, the AMDs, the Oracles, and that spilled into 2025. And now we've kind of really seen those trades cool off a bit. That's not to say that they're done or over, or they don't have any good fundamentals. That's not the case. But we've really seen the momentum on both of those trades die down. And now we're seeing that rotation into other sectors, broad-based, and obviously a lot of energy right now. But to me, it just shows retail's, they pay attention to this stuff. They pay attention to the trends. It's not just the headlines that they're watching. It's what's moving under the surface, and that's where they're trying to tune their portfolios to.
Yeah, and by the way, I think it's healthy, the moves that we've seen for the broader market, that it can still perform okay, really well actually last year, and be okay this year with everything that's gone on, and those big Mag 7 names are, in Microsoft case, down pretty big this year, 20-odd%. I'm just gonna, look at this chart, which no one can see, but you just have to trust me. Going back to what month would it be last? If I do sort of March last year, I mean, Microsoft over the actual last year is down about 4%. So a lot of that move is that 20% move this year has come recently, of course. Over the last 365 days, give or take, Google's still up 73%, and it goes back to that dip, that people bought, retail bought, and some of those names did, of course, very, very well. I do wonder with sort of Microsoft whether people eventually start to say, I tell you what, like this drawdown that you're giving us from those all-time highs, at what point does that become attractive? We're now trading only a little bit above the low from last year, where the market bottomed out. I think it's the 8th of April to be precise, and that was in and around, I'm just talking specifically for Microsoft here, $344, and it's trading at 370, so not a million miles away. So I do wonder for sort of retail investors, and maybe for those that are on YouTube, let us know in the chat how you feel about Microsoft, whether there's potentially a little bit of value there for you. But yeah, I mean, that sell-off has naturally been quite big. Bret, one of the things you mentioned, obviously these moves have come out of things that have done very well over the last sort of few years, like the Mag 7, and gone into things like commodities, and that's actually our second point. Commodity ownership has risen to 32%, up from 30%. It's not a massive increase, but still an increase. It's the highest level recorded since this question was introduced in Q3 2023. I've got a quiz question for potentially you, but definitely the whole audience. The reason I say potentially is because I've put it in our WhatsApp group yesterday. So if you saw it, then you can also you'll be able to cheat and get it. But since the GLD ETF was introduced in 2004, I think it was, or 14, one of them, 2004, I think it was. What is the most amount of red days in a row it has had? Did you see the WhatsApp message with the answer?
I did not see the WhatsApp
Okay,
answer
so
or
so
the
this is
post.
a good opportunity for a proper guess.
Well, for the GLD, so we just came off 9 straight days of declines, broke that yesterday. I'm going to feel like that's not the record. I'm going to say like 11.
Oh, if you had stuck with 9, that would have been the answer. That would have been the answer. Yeah. So yeah, 2004, late 2004 was when the GLD ETF was created. 1, 2, 3, 4, 5 times it has hit now 9 down days in a row. Never more than that. And 2015, 2016, 2020, 2022, 23 October, and now March. The average return 1 month later is 5.76%, 100% positive on that. But yeah, little stat for you all down the pub. You can all discuss that. But reasons for retail investors investing in gold. Brett, what are we seeing? Store of value, 32%. I mean, you'd imagine that would be the top one. Hedge against inflation, 28%. Expect further appreciation, 27%. Safe haven during periods of volatility, 26%. Diversification benefits, 22%. Protection against US dollar weakness, 15%. Store of value, 32%. I think that kind of makes sense, doesn't it? Being the
I
number one.
think so. Yeah, with what we've seen in the really, I would say like post COVID, it's like quickly been 6 years now, but just the fluctuations we see, not only in equities, but on the currency front. If you're looking at different markets, you're talking the euro, the dollar, you're talking about inflation. At one point, we were seeing 9% inflation here in the US. Putting your money in something like gold that holds onto its value, you see that price per ounce climb and climb and climb. That's reassuring. And I know we just went through this 9 day 9 day skid. Apparently, this record. I'll have to count it for sure before we wager a pint on it. But
Yeah.
no, kidding aside. But I know gold just went through this tough time, but you look at it, it's still up on the year. It's up 20% over the last 6 months, up 50% over the past year. I mean, this thing has the potential to be offense and defense. Obviously, there's a lot of moving parts when it comes to gold. A lot of things really push this thing around. But I think retail, I think they kind of know that. They notice they don't really like the last 10 days. Okay, sure. They've gotten a punch in the mouth maybe with it. But you go back over 6 months, when we started specifically talking to gold about retail investors, this was, I think, Q2 last year. So almost lapping a year on them. And we've seen that allocation increase over time. They're doing quite well. If they've been accumulating gold over that span, same thing could be said about silver. And if you really look back, gold has outperformed the S&P 5 of the last 8 years, and the S&P has been no slouch in that stretch. So, when I look at gold, it is this unique sort of asset for, yes, of course, it diversifies your portfolio. Of course, it's a good store of value, but it has this mix of offense and defense that I love. It's like it performs really well. It's not like you're getting this stability at the cost of, underperforming markets by a long stretch. It's actually holds its own pretty well. And the last point I would say is that sometimes the defensive measures of it are a little bit mixed, right? Like, we're seeing this conflict unfold now. Gold's actually doing quite poorly. Again, a lot of moving parts when it comes to pricing gold, but you go back to the situation a year ago with the tariffs, markets were getting smashed. S&P was down about 20% at the intraday lows. Gold was like hitting highs in that stretch. So it does help act as like a ballast, I think, during the stormy weather.
Yeah, absolutely. And with the recent moves in gold, like you said, for anyone that's been, a long-term investor in gold, you've been rewarded. And like you said, it's still up year to date. The moves, just to put it in perspective, over the last sort of couple of weeks or so, where it has come under pressure, and we had the record 9 days in a row to the downside, very similar to what we saw in 2022, where it first went down as people, gold is such a liquid product. It really, really is. So if you need that liquidity to go elsewhere and, very quickly, you can do that with gold. Same in 2020 with the pandemic when that started, gold dropped, flew higher. Same in 2008 as well. I was looking back at the chart. So look, I'm not saying we've now literally today seen the low in gold, but I think people would have been short-term interested in buying the dip. We'll have to, revisit that in the next couple of weeks. But it'd be interesting to see what happens when we get a similar kind of reaction there as well. Right, other commodities that people are invested. By the way, 69% amongst commodity investors hold gold, so that's pretty high. Silver in second, we probably would have guessed that 35%. Oil at 29%. It'll be really interesting in the next one to see whether that number goes up or down. I mean, who knows what's going to happen by the time people are asked. Natural gas 20%, copper 18%. I reckon that number for copper might increase over time as people look at the relation with sort of the AI and the infrastructure there. That wouldn't surprise me if that maybe looked to increase. And Lale made a good point. I'll put the link in the bio. I'm pointing to it on YouTube right now. About this, where this was people were asked this before the latest geopolitical developments that we've had, and retail investors were already increasing their exposure to these tangible assets. So it's not to say they all saw it coming, but they considered it and thought about it. And we've had a volatile quarter one. We had a volatile quarter one last year as well. So maybe they thought, here we go. But yeah, interesting there on commodities. As we said, gold sort of remaining dominant there. And the stat we've gone with, 69% of commodity investors are exposed there as well. I mean, it's been volatile, hasn't it, the last couple of weeks? I mean, our last point is obviously tied into all of what we've said so far. International conflict emerged as the top concern for investors even before the latest escalation that we've seen in the Middle East. We fast forward 3 months from now, things could be looking a lot better, or they could be worse. It's hard to predict. It really is. I think we've said this last sort of couple of weeks. But before this even escalated, retail investors were aware of it. And that's fair play to retail investors for getting that right.
Absolutely. And I mean, how many times do we do this survey where either economic worries or inflation were the top two concerns? I mean, it was to the point where I was like, why do we ask this question anymore? There's always going to be these two worries. And then we finally saw the shift. We actually saw the shift in Q4 as well. It wasn't just in this most recent one. The shift to geopolitical concerns, the shift to political uncertainty. Those were the top two worries last quarter. So to see the tension here, it's not like, again, and this survey was done well before this started. Retail has sort of had this on their radar. You go over the last 3 or 4 months, and I think they've started to position their portfolio in that way too. They've increased their diversification. They've sprinkled their assets around into different. It's not so concentrated in from my perspective in U.S. equities. Globally, obviously it's going to differ to home markets and whatnot, but to see them sort of position themselves for that, gold being one way to do it. Oil in this case actually quite a good allocation to have if you came into March long oil at that point. But I don't know, Sam. I'm curious. Like, how are you kind of thinking of retail? Like you said, they don't have a crystal ball. They're obviously not going to go 10 for 10 on their strategy, but they seem to be pretty in tune in terms of the risks.
They do, and historically they have been as well. And I think they've nailed this before the actual fact unraveled, really. So I'm fascinated to see what they will have to say in 3 months' time. Admittedly, we're 2 months away from that. What could happen? We've obviously got the main thing right now. It's going to be around this geopolitical situation. It's going to be what happens to oil prices and the impact that has on inflation, the impact that has on central bank and interest rates. So it could be that this situation has worsened in 3 months, and then it's interest rates are the biggest issue, along with inflation again, or things get a lot better. And then the next thing that we're all worried about now is actually the AI hype, these big capex spends, and how are we actually going to see results from it? So a fascinating 3 months ahead of us. I mean, I think earnings are what? I mean, next week or week after it all starts to kick off again. I mean, that's going to be important. Maybe more or less so depending on the geopolitical situation. But what a big 3 months we have next ahead of us. And I think it's one where investors have got to be quite selective, don't they, right now?
I think so too. Yeah, I mean, overall, I'd say the markets have been fairly resilient given what we've seen over the last month. But I think we do start to see we've started to see a little bit more. That first couple of weeks of the month, the markets were like, okay, this will be fine, and then oil went up and didn't come back down. Things haven't really been resolved, and they're starting to see a little bit more of that risk off sort of worry manifest. We haven't had any sort of capitulation, I guess, which would be, you can argue one way or the other whether we want to see that, or maybe at this point you just call this fairly routine sort of pullback in that 5 to 10% range, which is reasonable. But yeah, in the next couple months, similar to last year, lacking some of last year's volatility at this point, but similar to last year, are we going to find our footing in that Q2 area and set ourselves up for the back half of the year? Be really interesting to see.
Yeah, I mean, just final point to finish on. There'll be a lot of retail investors out there at the moment where their year-to-date portfolio will be in the red. And I actually tweeted it earlier. I was like, some of the best investors everyone will know and look up to, their portfolios, a lot of their portfolios will also be negative right now, and it's completely
Definitely.
understandable. I mean, listen, by the way, the S&P 500 average intra-year drawdown 14%, I think it is off the top of my head.
Yes.
We haven't even had that yet. So it's I'm not going to call it a minor blip in the road, but we haven't had that average intra-year drawdown yet. We're not even 3 months into the full part of the year. It comes down to a great saying, doesn't it? Time in the market beats time in the market. I think people
Yes.
sometimes, for people that are worried, I'm not saying everyone is or should be, but you can have a little bit of perspective here and realize, it's a long, you've got to have a long-term vision, haven't you?
Yeah, I mean, look, we had back-to-back years of more than 20% return in the
Mm.
S&P. Last year was, call it 15. Look, if you want to be able to take those 15 and 20% years, you're going to have periods where you have to have those down 10, down 15%. It's the price you pay to participate in the long term.
Yeah, absolutely. Absolutely. And then sometimes you get opportunities like, and I'm not saying it is one, let's just argue and go into the future and say it was, where Microsoft is down 20, 25%, and you get that opportunity to buy like Google last year, and you get those returns. So for some people, they kind of welcome these dips as well. Let's not forget that
Certainly.
too. Right, Brett, we'll wrap it there for this particular podcast series for another 3 months. I'm looking forward to hearing what retail investors are going to say next. But until then, thank you as always.
Till next time.
Take care.
You too.